I also want to broaden this out to euro dollar and what it means for an ECB versus Fed conversation. And Steve, you referenced this in a note that came out last night. If you come inside the Bloomberg here, the top panel is German 5-year real yield versus euro dollar. So euro continues to climb higher, that blue line, whereas real yield continues in negative territory, down 143 basis points, negative 143 basis points. The bottom panel is the dollar index, that purple line, rolling over versus the U.S. 5-year real yield, which is in positive territory, positive 28 basis points. Why?
Look, I think that there are two factors in the dollar right now. The first I'd say is that we had a lot of good dollar news at the end of last year, tax reform and stuff. And I think traders just took note of the fact that it didn't go anywhere. That wasn't enough to stimulate it, and the question is what next. The second thing I think is that if you take a look at the way U.S. real yields have gone, despite the fact that inflation expectations have climbed steadily, their climb has been steadier than Bitcoin's move. It's been steadier than any other asset. You're not seeing any response on the inflation side or on the rate expectation side. So I think the market is saying, look, this is going to be a new Fed. They're really looking at the new names that are coming here and saying this is going to be a real break. It's not going to be the Fed that more or less targets a Taylor rule. You don't have to be strict about it. They're saying this is going to be a Fed that's going to be more tolerant of inflation than the Yellen Fed or the Bernanke Fed would have been. I think they're wrong, but I think if you look at the way inflation expectations are moving, but not real yields and not nominal yields to any great degree, it's telling you that the market is saying we really don't believe that they're going to respond the way previous Feds have responded.